She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
Thank you for tuning into my show. I'm Debbie Marcoux, and I am the Mortgage Mom. I'm licensed by the Department of Financial Protection and Innovation under the California Business Consumer Services and Housing Agency, NMLS ID 237926. Also licensed in Arizona 0941504, Florida LO 76508, Georgia 69178, Hawaii 237926, Idaho MLO 2080237926, Illinois 031.0058339, Nevada 57237, North Carolina I210940, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom.
This is Debbie Marcoux, the Mortgage Mom. Well, I've had a lot of questions lately. What can I do to bring my monthly payment down until interest rates get better? Well, if you are a buyer and you're out looking at homes, what you want to focus on is a program called a 2-1 buy down. If the market rate today is 7%, you would start your first year at 5%, year 2 at 6%, and year 3 through 30 would be at that 7%. It's a great way to enter the market today, knowing that rate cuts are just around the corner. Give us a call or head on over to our website at mortgagemomradio.com.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926.
When you're in need and don't know where to go, pick up the phone and call mom.
All right, so welcome to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and I did run that commercial just to give us a little bit of time to let people join. I want to remind everybody that this is an interactive show. I want you to ask your questions. I want you to put them into the feed, and I will read them out loud and answer them for you. I thought that today, now number one, the commercial that ran right now talking about the 2-1 buy down program, that really is a fabulous program for somebody who is purchasing a home. Interest rates, that recording I did a year ago, and it was actually in May of 2024. So me talking about 7%, 6%, 5%. Today, truly, we're talking about 6.5%, 5.5%, 4.5%. So if you are purchasing a home and you are interested in how you could take advantage of a 2-1 buy down, give me a call. Talk to me. I want to help you. I want to answer your questions. I want to make sure that you get the information that you need. Now, today I'm going to be talking about loan programs that a lot of people don't know exist. So, we're going to talk about no ratio loans. How do those work? A no ratio loan, what is that? We're going to talk about construction loans. We do have from ground up construction and renovation. A lot of people don't know that that exists. Many people have started a project, they run out of money and they can't get, the home completed. And this gives you an opportunity to do that. We have debt service ratio loans. So what is that? Again, a no income qualifier type of loan. So we're going to talk about that as well. Obviously, there's all kinds of loan programs for the standard person wants to put little money down. We talk about those quite frequently. Down payment assistance, 3% down, 5% down. Today, we're going to talk about the out of the box type of programs. So that is what we are going to focus on today. I could see that Mary jumps on. She says, do you have to be a first-time buyer for that buy down loan? So actually, no, you do not. You do not have to be a first-time buyer. You can actually get that same program on an investment property. You could get it on a second home or vacation property. You can get it on a primary residence, and you do not have to be a first-time buyer. So fabulous question, Mary. I love it. Michael says, hello, it's been a while. Hope all is well. Michael, thanks so much for jumping in. It has been a while since I have seen you on, and I love that you are joining. So thank you. And again, I want to remind everybody this is interactive. So just like Mary did, please ask your questions, put them into the feed. I am more than happy to read them out loud and answer them for you. So let's start off by talking about a no ratio loan, a no income qualifying loan. So what exactly is that? So that is going to be a program that is for a primary residence. And I can tell you that there are not very many lenders that can offer this loan program. Primary residence, you can't get hard money on a primary residence. It has to be an investment property if you're looking at hard money. Hard money is usually the go-to for people that are buying an investment, doing maybe a fix and flip. That many years people have been going to hard money. They don't have to show income documentation. Credit scores really don't matter. And it's just a way for them to get money to do whatever it is that they're looking to do. Now, you can't do hard money on a primary residence, and hard money is going to have a lot lower loan to values. So what I mean by that is, let's say that you're buying something for, $500,000, and you want to get into that property. You're probably going to have to put down somewhere around 30% on a hard money loan. Now, there are some hard money lenders that might go, higher than that, but traditionally they have much bigger down payment requirements. You want to buy something to do a renovation, fix it and flip it, or you want to do construction, buy land and actually build something from ground up. You're looking at like 50, 40, maybe 60 at the highest loan to value. So you're talking about 40, 50, or 60% down payments. So we do have construction loans that are going to let you do less than that. So let's jump into no ratio. And it looks like my dad jumps on. He says, "Hi, I hope I made it here this time." Dad, you did. You're commenting. So he's also said that he's had a hard time commenting on the live feeds. So good to see you get on. And I always love it when my dad joins. So let's talk about these no ratios, the no incomes. And then we'll get into construction. We'll get into renovation. We'll get into bank statements. If you have questions about something in particular, don't wait for me to get there. Just start throwing those questions into the feed. We'll switch gears really quick. I want to give you the information that you are looking for. So no ratio, no income, primary residence. Let's talk about it. So you can do these loan programs. Of course, think about it this way. The lender that is offering it to you, the investor, is taking a lot of risk. They are not checking your W-2. They are not looking at your pay stubs. They are not looking at tax returns if you are self-employed. They are not verifying even where you work. On a loan application, we do not even put in the name of your employer. There is no phone call that is even made to confirm that you are employed. So this is a lot of risk. With risk comes higher interest rates. It's just the way that it goes. If somebody's willing to give you money without verifying any information, they're going to charge you more money. You're going to get charged up the butt. It just happens, okay? But it is a way to get into a property. So for example, right now I've got a client that is a perfect candidate for this program. He is into Bitcoin. He makes money in Bitcoin. He puts all of the money that he makes back into Bitcoin. He is not cashing any money out at all unless it's small amounts that he needs to pay a couple of bills. So we don't have any tax returns with any kind of capital gains for cashing out or selling the Bitcoin. We don't have any tax returns to see any income that's being made. He's making money and he's putting it right back into the Bitcoin. It's all going right into Bitcoin. There's no way for us to verify income. Perfect candidate for this. We've got other people that are looking to make a move. They want to get out of whatever state they're in, most of them California, and they want to go somewhere else, but they don't want to have to be forced to find a job before they move. They want to sell their house they're in now, or they just want to pack up their rental. They want to get in the truck and they want to go. This is okay. They want to get there, they want to get settled, but they want to buy a house and then find the job. Okay, no big deal. Perfect candidate for this type of program because we have no way to verify the income that you make. So let's talk about what you need to get into this program, because with risk, there's also bigger down payments, higher credit scores, things that are required. So you are going to need to have a couple of different things. 720 or better credit score for 20% down payment. You are going to need a 680 or better credit score with a 25% down payment. And they can do a 660 or better credit score, but it is on exception So it's going to be, review it and make a decision. There's no actual guideline to it. I've seen most of those turn out to be wanting 30% down payment, wanting to have bigger reserves. So with the 720 credit score with the 20% down and the 680 credit score with the 25% down, they do require that you have at least 6 months of reserves. So what are reserves? What am I talking about? Months. So reserves are the total monthly payment that you would get on the property. So we're talking principal and interest, property taxes, homeowners insurance, and if there are HOA dues, those have to be factored in as well. So take that total monthly payment. Let's just pretend for ease of being here in front of you guys, no calculator in front of me. Let's just pretend the payment is $5,000. 5 times 6 is 30 grand. You would have to have $30,000 in excess liquid money on top of your 25% down that you need to get into the property, plus, of course, your closing costs. The interest rate that I ran yesterday with a 680 credit score with 25% down on this program was 8.875. So if you think about that, yes, it is expensive. Like I said, you're going to pay for this program, but with risk, the investor wants more. They want more return on their money, which absolutely makes total sense. Now, why is this better again? Like I mentioned at the beginning, well, I could just go hard money. Well, hard money is going to be a higher interest rate. So with hard money, you're getting on average interest rates that are between 10.5% to 12.5% on average are those hard money loans with the lower loan to values. So an even bigger down payment requirement. Cannot do it on a primary residence. They're talking about investment, properties only. They're talking about, basically commercial type reason or need, right? So you're buying it to rent it out. That would be, looking at that like it's a business. It's a business purpose loan. That's where I was going with that. So hard money is business purpose only. Okay. You're buying it, fixing it, flipping it, buying it, fixing it, renting it. And that is not what this program is. This program is for an owner occupied property. And it does go all the way up to a $2 million loan amount. So not checking on your income, not validating where you work. All you're coming up with is your down payment, your closing costs, your reserves, and your credit. Pretty good if you ask me. Michael jumps on and says, or Michelle, she jumps on and says, what is the rate on 15-year term with 20% down, please? So Michelle, are you talking about this particular program that I'm discussing right now, the no ratio, no income docs? Confirm that for me. And then I will get together with me, either send me a text, send me an email, or call me when the show is over. Since I am here and I'm actually, so you guys can see my other chair over here. That is actually my work computer. This is just my studio desk. So I don't have any of the links to get into pricing. But if you do reach out to me, text me, call me, or email me, I will give you whatever the interest rate is that you are looking for. But confirm for me, okay, owner occupied with docs. So I actually ran, and again, everybody's going to get a different interest rate. A refinance is going to be a different interest rate than a purchase. A cash out is going to be a different interest rate than a rate and term refinance. So we've got to do that one-on-one together. I can tell you that it is in the fives. I did run a rate and term refinance, 15-year, but it was a lower credit score. I want to say I was looking at a 700 credit score, and we were looking at interest rate around 5.5 to 5.625, and that was a couple of days ago. So Michelle, purchase owner occupied with docs, perfect. Just send me an email or text me. I will get together with you. I'll find out what credit scores are, and we'll run those rates together, and I'll tell you exactly what they are. So great question, Michelle. And I'm anybody that has a scenario that they want to know what their exact rate would be for their their particular loan, it's that easy. Text me, email me, call me. I will run it for you and I will tell you exactly where you would be. So definitely, Michelle, reach out after the program is over. So once again, getting back to that no ratio loan, that is for a primary residence, no income docs, and I gave you guys all of those great deals. Fabulous program for somebody that cannot show income, period. And there are reasons for that. So number 2, let's get into loan program and keep them coming, guys. Michelle, like I said, I will absolutely help you out and get you an interest rate. Let me see if I can actually, and I will try to do it. I don't think I can get in from here. I cannot get in from this computer. It's not saved. So I do apologize. Just get with me after the show and I will run it for you. So let's jump into, I talked a little bit about hard money. That's not a program that nobody knows about. Everybody knows what hard money is. So we're not going to talk about that today, but we are going to talk about bank statements. A lot of people don't know about bank statements. Bank statement loans are fabulous. They are made for the self-employed borrower. So if you are not self-employed, you do not qualify for a bank statement loan. Bank statement loans, again, you have to be self-employed. We are going to look at your business bank statements. We will look at personal bank statements. Why would we look at both or one or the other? Truly depends on how your business is run. Some people are incorporated. They have a C Corp. They have an S Corp. Other people have an LLC, and some are just a sole proprietor. They are not incorporated, and they're doing their taxes on a personal tax return as a Schedule C. And so they are utilizing just an actual bank account, a personal bank account. So depending on you and what your circumstances are will determine which type of bank statement that we are going to look at. We will look at anything from 12 months of bank statements to 24 months. Why would we look at one over another? So, if your business has been maybe you were in a decline. So let's say over the last 12 months, the very first, and we're looking at not January to January, guys. So a bank statement loan, if I say I'm doing 12 months of bank statements, it is September the 24th. I am actually looking at August of 24 to August of 25. So we are going to go straight out the gates, wherever we're at the time of application, we're going to go 12 months. So let's just pretend that in August of 24, your business was kind of in a rut, right? But if we had gone 12 months before that, everything was great. It was prosperous. And then August, September, and October just weren't looking so good. And then all of a sudden, now you're right back to where you were back in 23. So in that situation, we'd want to look at 24 months of bank statements because we want to get that better average. But we can look at bank statements for somebody who's self-employed. And how does it work? This is very important. We are going to look at deposits that came in that were income generated. So if you're in construction, you're a contractor or handyman, right? Just as an example. And you go to the Home Depot and you buy a bunch of supplies and you go and do a job and you get a deposit. And then you had some extra supplies that you bought that you didn't end up using. And you go and you return those to the Home Depot. We are not going to allow you to use the income, the deposit that came in from a return of that merchandise. But we are going to let you use the income that came in from the job. And that's the full job, right? So we're going to, if somebody, you went and you bought the supplies for them and it cost $2,000 and your client refunds you the $2,000 for the supplies plus the cost of the repair, we're going to let you use that whole deposit. But how does that work? We're going to take that whole deposit and we're going to give you 50% of it. 50%. That's it. It's that simple. Now, there are some industries that we're going to give a higher percentage of your deposits to. So for example, somebody that works in marketing and they're sitting behind a desk all day long and they're using programs that they've purchased. One-time purchase is all it needed. And they get into their Adobe, Photoshop or their Adobe Premiere Pro, and they're creating all of these, marketing things, and they're posting to social media and, whatever it is that they're doing, they have very, very little overhead, not a lot of expense in the kind of industry that they're in. then based on a letter from their CPA saying, hey, my client's overhead is really only about 30%, then we're going to go ahead and we're going to give them 70% of the deposits that they bring in. So it depends on who you are and what you do for a living, but very, very simple. We're going to go through, we're going to add up deposits. We're not going to give you any refunds for, things that you returned at a store. If it was a one-off deposit, it was a refund from, taxes that you paid out and then you got a refund because you paid too much, or, it was just a one-off deposit that had nothing to do with income. We're not going to utilize that. But that is really, really good for the self-employed borrower who most likely the majority of write off as much as they can so that they don't have to pay, as much in taxes. So really great program for that self-employed borrower. Why Not got on and he says, how long do you have to have your company or business to have being self-employed to qualify you? Okay, so I get what he's saying. So he's asking you, how long do you need to have been self-employed in order to qualify? So for the bank statement program, there are some lenders that will allow you to be self-employed for 12 months. We have closed those loans. Again, risk is going to play into the interest rate that you get. So if you have only been self-employed for 1 year, is there a loan out there for you? Absolutely. Are you going to get a little bit interest rate than if you had been self-employed for 2 years or more? Absolutely. So you are going to get a slightly higher interest rate if you can only prove that you have been self-employed for 1 year, but 1 year would be the minimum. So great question. Why not? Keep them coming. And he says, if you have a couple of businesses, how does that work? Well, we love you because obviously you're an entrepreneur. So we're going to look at, again, each one of those businesses would have to be in play for at least 1 year. So we're going to look at the deposits. We're going to look at the bank statements for each of those businesses. We're going to verify with your CPA if you have been, how long that those businesses have been, in production for, and then we're going to go from there. So if one of those have not been 12 months long, then we're not going to be able to utilize the income coming out of that one particular company. Okay, so I think I got all those questions. You guys keep them coming. I love the questions. I want to answer them for you. And going back to you, why not? Because I know you watch the show all the time. Again, one of my favorite followers who just always jump on whenever you can. I know that you are also a first-time buyer. I know that you are looking to buy your personal property. And so if for some reason for you, a bank statement loan didn't work for qualifying, we could always then go over to that no ratio loan. So let's talk about down payment, because this is where we're going to go, hey, is the bank statement loan better or is the no ratio loan better? So let's talk about that. So bank statement loan is going to have, number one, a lower interest rate, by far, lower interest rate. Those right now, again, depending on whether your credit score, whether you've been in business for 12 months or 24 months or longer, how much money that you're putting down, those right now are going to be in not 8.875, like I just told you guys for that no ratio loan, literally verifying nothing, but you're looking at, mid to low sevens on those. Primary residence, you could even be getting into high sixes, 6.875. So you're going to be somewhere between maybe 6.875 and 7.5. So why a big spread? So again, risk. So what's your credit score? So when I start talking 6.875, I'm talking about primary residence. I'm talking about high credit score. I'm talking about 25% down payment. So bigger down payments. So 7.5. Primary residence, 10% down payment, still a really good credit score. You could be at 7.75 if you only have 10% down and you have a 680 credit score. So credit score, down payment, how long you've been in business, primary residence, those are all going to make a big difference with a bank statement loan. You can do a bank statement loan for an investment property. You can do a bank statement loan for a vacation second home. So interest rates are going to change based on what you're looking at that loan type for. So if we're looking at bank statements for an investment property, and you're going to need to have at least a minimum of 20% down. That interest rate is going to be around 7.5 to 7.75 if you're only doing 20% down on an investment. If you've got 25% down or more, that rate's going to come down about 7.25. So you can see how rates change, and it's not drastic, but it changes and it moves with risk. What type of property is it? If it's an investment property, it's not where you're going to live. There's more risk that it's a lot easier if the market tanks to just walk away and say, forget about it. I don't need it. So what its purpose, what is it for? Investment, second home vacation, primary residence, how long have you been in business, what is your credit score, what is the property type? So single family, condo, 2 to 4 unit, those are all going to change what the interest rate is that you will get. But a fabulous program for somebody who is self-employed that cannot qualify going the method of tax returns. So, you got to actually show that money and pay those taxes on that income to qualify when you're self-employed. And that can make it very difficult for a self-employed borrower. So fabulous product. I love it. All right. So now let's move into a debt service ratio loan. So why would somebody do a debt service ratio loan? So this is for somebody that cannot qualify using bank statements, who might be self-employed. This is for somebody who cannot qualify showing W-2s and pay stubs, okay, that would not qualify if they showed those things. But this is for an investment property only, okay? So this is not for the primary residence. This is not for the second vacation home. This is for an investment property only. So what is a DSCR loan, or a debt service ratio loan? That is what DSCR stands for, debt service ratio. So what we are doing is we are looking at the income that can be achieved from the property as a rental. Okay, so what are the common rents for the area? What will that property bring in monthly in rental income on average? Now, there's 2 ways to look at this, and I get it all the time. So we're going to talk a little bit real quick about Airbnb and VRBO income versus long-term 12-month rental income, okay? Because it is different, and it is very important to talk about with this debt service ratio loan. And what I'm going to do really quick before I jump into Airbnb and VRBO is I'm going to run a 1-minute commercial just so that I can take a sip of water. And if you guys have questions, keep putting them into the feed. I'm going to be right back. So stay tuned. Hi, I'm Debbie Marcoux, the Mortgage Mom. Have you been waiting to get a debt consolidation done? You want to refinance, you want to pay off your debts, you want to do some home improvement. Maybe you've had your plans on hold forever. You want to sell, you want to move, you want to downsize, you need to upgrade, but you have been waiting for these interest rates to come down. Well, now is your chance. The Federal Reserve just cut interest rates by 0.25% today. They're talking about doing this again, possibly up to 3 times by the end of 2025. So this is your chance to give me a call, to reach out, to talk to me about your goals, and to get things started. How do you do that? Well, you call my office. It's 844-935-3634. That's 844-WE-LEND-FOR-YOU. WELEND and the number 4. You can also head on over to my website at mortgagemomradio.com. I do have a contact us button there, or send me an email to debbie@mortgagemomradio.com. Talk to y'all real soon. Bye-bye.
I'm Debbie Marcoux, and I am the Mortgage Mom. I'm licensed by the Department of Financial Protection and Innovation under the California Business Consumer Services and Housing Agency, NMLS ID 237926.
Okay, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux, and thank you guys so much for letting me run that quick commercial. I needed to get a little bit of water. So let's jump into the VRBO, Airbnb rental income. Your thought is, I want to buy a rental property. I want to rent it out. I want to use, Airbnb. I'm going to make way more money that way. And there's a very good chance that you might. Now, I have a lot of clients who had Airbnbs and VRBOs, and then they decided to go the route of the traditional 12-month rental. It just became too much for them. There was a lot of damage because it was, weekends and bachelor parties and bachelorette parties and things that they were having to clean up. And, they were just kind of over it. It was just a lot more work for them than that long-term renter that lives there, kind of has pride of ownership to an extent. They don't own it, but it's where they live and they want it nice and they keep it clean. And, a lot of times there's a lot less issues with the longer term rentals, but the rental income that you can achieve will be lower when you're doing long-term 12-month rentals than it would be in that short-term market. So let's say that your goal is to buy that Airbnb or that VRBO, and you know that your income that is, possible on that property is going to be significantly more than what it would be if it was the longer term. Okay, so when it gets to the debt service ratio, this is the way that it works. If the property does not have enough rental income coming in on it to cover the principal, interest, taxes, insurance, and HOA if it exists, you can still get a loan against the property using a debt service ratio loan. So a lot of people believe that the property has to rent for enough to cover the whole thing or it won't qualify. This is not true. This is actually negative. Now, what does happen? If the property doesn't have enough rents to cover, the interest rate is going to be significantly higher. Again, risk. We're not verifying income. We have no idea if you have the ability to make the payment on the property. The rents that could be achieved are not going to be enough to carry the nut of the property. So your interest rate is going to go up if there is not enough rental income to carry it. But you can still do it. We have those programs that are available for you. So don't think that it can't be done if the rents aren't there. So now let's talk about Airbnb. The next thing I get when I'm on the phone with somebody is they say, yeah, but Deb, I'm going to Airbnb this thing and, it's going to make me X amount of money. And where I would only get, maybe $3,000 a month from a long-term tenant, I'm going to be making $5,000 or $6,000 a month by doing this as short-term rentals. Okay, cool. Is the property that you're buying, does it have a history of being a short-term rental? So are you buying the property from somebody who has already been putting it up for rent on Airbnb or VRBO or some other site that does the same thing? If we can get a report for the last 12 months of what that property brought in, we can average that out and we can utilize that additional rental income to qualify that property, in turn giving you better terms. You're getting a lower interest rate because the income will cover, the total monthly payment. So that is totally doable. But if the property does not have a history of being a short-term rental, so there is nothing for the investor or the lender or the underwriter to go back to verify what that income would be for those short-term rentals, they are not going to allow you to utilize that income. We're going to have to use the income that the appraiser tells us is average rent for that home for where you're purchasing. So we can look at that short-term rental income. It is very possible. But if you are out and you are looking to purchase a new home for that reason, try to focus on one that has already been operating as an Airbnb or a VRBO or the other sites that are out there as well. Try to look for one that has already been operating that way. Number one, we're going to have the history of the income that they've brought in. So you also have the history of the income that's been brought in to know that you're making a good purchase. Number two is that you will probably be able to negotiate with that seller to possibly buy that property furnished, which would make it a lot easier for you to just jump on board into that property and take over. Number three, that person that has been doing that and running it that way most likely already has that cleaning company already set up to go in and to do that cleaning and to do those services when one person's leaving and the next one is coming in. They've probably already got a management company that's been helping get things booked. So it really does help a lot if you're looking down that direction to try to focus on buying one that has already been one. Now, can you buy a property that's never been a short-term rental before and do it all from scratch, all on your own? Gosh darn it, yes, you can. It is absolutely possible, and that's how probably the person that I'm talking about that has a property that is a short-term rental had to do it from scratch. But I'm giving you a little bit of insight. Hey, it would be a lot easier if you're going to be able to qualify with more rental income, and you're going to probably be able to jump into a streamlined operation, making it a little bit easier for you to take over. I can see 212 Tactical Design says, my name is Blanca. Not sure how my name pops up here. But I think you just answered my question. I was going to ask, how would one qualify or go about it if one wants to buy a property as an investment that was not a rental? Okay, so great question, and I love it. And Blanca, welcome, and thank you for being here at the show, watching the video, and asking your questions. So again, the appraiser is going to give us, we are going to always do an appraisal on every property that we do lending on. And when you're buying a property that is going to be for investment purposes, we are going to ask that appraiser to tell us what the average rental income is for that property. And they are going to do that research for us and give us the comps on rents, which are based on long-term 12-month rentals. And if you are looking for something that would be a short-term rental, then that is what I was just talking about. We're going to get the information from the person that you're buying the house from that had the short-term rental. Now, mind you, I have been talking purchase throughout this whole show and with these different programs. But I want you guys to know that all of this can be done as well with a refinance. So if you have an investment property that you need to do a refinance on, we can use a DSCR product. We can use a bank statement product. If you own a home, your primary residence, and you need to pull out cash, but you're just not going to qualify with those W-2s, with those pay stubs, or with those tax returns, we can absolutely look at that no ratio program as a way to get you the cash out that you need. So just keep that in mind. Whatever I'm talking about here today, all of these different loan programs that people didn't know exist, we could also utilize these for refinances as well. So keep these questions coming. I absolutely love it. And I want you guys to keep asking me. So we've covered DSCR. We can do them even if the rents are short. Absolutely no big deal. You're just going to end up with a higher interest rate. Investment property, single family is going to start at a 20% down on that DSCR. We can go down to a credit score at 700 or above. If you have a 680, I believe we have an investor, maybe one or two, that might be would consider doing it with exception, but it's going to be a one-off scenario. So you're going to have to contact me. We're going to have to talk about it. I'm going to have to make calls and see who I can find. But figure that on that DSCR, that investor product, it is an investment property. They do want you to have a little bit higher credit score, so 700 or better. On that bank statement program, I mentioned it. Why is bank statement better than no ratio? No ratio is going to be a minimum of a 20% down program, but you don't have to show me anything. Bank statement program for that self-employed borrower, I'm going to need, you can do 10% down on that program. And then up from there. So kind of trying to make sure I keep all of these things squared away. And last but not least, let's talk real quick about construction, renovation. You were in the middle of a renovation, you ran out of funds. Construction, you want to buy a lot and you want to build. We have those programs. They do exist. They can be for prime, depending on what you are looking for to do it for. So the programs that I have are not for primary residence for construction. They are not primary residence for construction. The full construction product that I have is for an investment property or a fix and flip. So you're going to renovate and flip, or you are going to renovate and keep it, or you are going to build it and keep it, or build it and sell it. So if you were going to do like a spec home, you wanted to buy the land, build the property, and then market it and sell it. So that is what the construction product is that I have available, is not for primary residence. For a primary residence construction loan, you're going to want to absolutely Google it, talk to your contractor to see who maybe they have referred people through. I have sent numerous people to US Bank. US Bank does have a great construction program and product for the primary borrower, so the primary residence, the person that is going to build it and live in it. They do have a really great product, so that would be your source for that. But when you are trying to do this for an investment, you may not necessarily qualify with income docs to get the loan to build the property, to buy the land and do all those things. So these programs that I'm talking to you about are for people with business purpose. They want to build it and flip it. They want to renovate it and flip it. They want to build it and then they want to rent it. So I have the program that I have available for those things does not require W-2s, tax returns, no income documentation at all. What their biggest concern is that you have reserves to make sure that if you had to carry this payment on this loan for a little while it was being built, that you have enough money in the bank to make those payments. That is really their biggest concern. Credit, obviously, they want you to have good credit. We've got to go 720 and above on these products. You could walk in, you could pick up something that somebody started a build and it was mid-build, it got framed and nothing else, and the builder ran out of money. Go buy it, let's build it, let's flip it, let's rent it. Great product, great program. A lot of people don't know that it's out there and that it's available. And they're going to go up to really good loan to values. So these programs right now can't qualify for, to do this type of loan. It's for your investment property. You're buying something half done. You're going to renovate it and flip it. A lot of investors will go to hard money, as I mentioned at the beginning of the show. But with that hard money, you're looking at 50 and 60% loan to value. So if your land is going to cost $100,000 and your build is going to cost $400,000, so your total all in out of pocket is going to be $500,000 for the project. Hard money is going to probably give you $250,000, maybe $300,000, 50 to 60% loan to value. With this program, you're going to be able to get up to 80% of your total, inception cost. So really awesome program. A lot of people don't know that it exists. It's a better option and opportunity, higher loan to value than going with a hard money lender. So these are kind of programs that I wanted to touch on. I thought it was important to do that today. Every week has been about what's going on with the market, what's happening in the market, where are interest rates, what did the Fed say? That's kind of been what my last 4 or 5 shows have been about. So I thought I'd bring it back to lending, back to mortgage, and I would talk about that. Tactical Design says, how much reserves needed for a no ratio or a debt service ratio loan? So great question. I'll touch on that. So you do need to have 6 months reserves for the no ratio loan. If your credit score is, you have to have a 680 or better credit score with 25% down payment and 6 months reserves, or you need to have a 720 or better credit score with 20% down and 6 months reserves. So the no ratio is basically 6 months reserves. They will go down to a 660 credit score on that program, but they do, it is an exception that has to be made, and they are looking for a good reserve. So expect that they would probably want 12 months reserves if you had a lower credit score than a 680. Now on the debt service ratio, the DSCR product, that again, you are going to want to have a minimum of 6 months reserves. Again, interest rates that you guys get are going to be based on risk. So if you've got more than 6 months in reserves, you've got 12 months in reserves, or you've got 24 months in reserves, there might be an investor that's going to have a better interest rate for you than another investor that's only going to require the minimum of 6 months. So we are going to search. I've got probably 10 different investors that do DSCR. I've got 2 different investors that do the no ratio. I've got about 15 investors that do the bank statement product. So we've got a lot to work with, guys. And, if I can't put it together, underwrite it in-house, then I'm still going to try to find a home for you. So please, if you feel like you're not falling within the guidelines that I'm talking about, you're not falling within those parameters that I'm giving you, still reach out. Tell me what you got going on. Tell me what your goal is. Tell me what you need. Number one, maybe let's take a look at your credit. Is there something that we could do quickly to try to improve the credit score? Maybe you're concerned that the bank statements wouldn't give you enough income to qualify. Well, let's look at them and let's see where you'd be at. Can we change it so that I'm not using 50% of the deposits and we can use 70% of the deposits instead? What kind of industry are you in? So you've got to start somewhere. You have to start with a plan. You have to start by talking to somebody. You have to start with figuring out what you need. You've got to make that roadmap. Once you know what the roadmap is and you know what you need to have, what you need to do, how much money that you need, then it's much, much easier to execute and to be able to get into what it is that you need and what it is that you want. So Tactical did say, forgot to ask, or maybe I missed it, in what states? Okay, so I am licensed, and I'm going to pull this up. I have to actually read it to you guys because I don't remember them all off the top of my head. So I personally can help you in Arizona, California, Florida, Georgia, Hawaii, Idaho, Illinois, Nevada, North Carolina, Oregon, Tennessee, Texas, and Washington. Now, the company that I work for is licensed in many other states that I am not personally licensed in. So if there is a particular state that you are looking at that you would like me to check and see if I could refer you off to one of the loan officers in my family, in my company family, I would absolutely be happy to do that. And then obviously, if I can't do it in-house, then I would be more than happy to give you a referral off to somewhere or another person maybe that is in a state that you're looking in. So very good question, Tactical. I absolutely love that. So with that, I have hit on some really great loan programs. I'm going to stop it now. We're at about 46 minutes. A lot of people don't really like to go much longer than that. But this was a great show. I appreciate all of the questions today. And I do want to remind everybody, if you guys are thinking about buying, selling, refinancing, a reverse mortgage, a home equity line of credit, hard money, whatever it is that you might need, you should be thinking about Mortgage Mom Radio. You should give me a call. You should go to my website. You should send me a text message, or you should shoot me an email. You got every way under the sun to reach out to me, and it is always me that responds. And if it's not me, it's one of the girls from my team, but they are absolutely fabulous, and everything comes through, and I see everything. So mind you, if you talk to somebody that is not me, I also know what the heck is going on with your file. So how do you guys do that? Mortgage Mom Radio, 844-935-3634. That's 844-WE-LEND-FOR-YOU, WELEND, and the number 4. You can go to my website, mortgagemomradio.com. You can send me that email to Debbie, DEBBIE, at mortgagemomradio.com, or you can shoot me a text message to 844-935-3634. That's 844-WE-LEND-FOR-YOU, WELEND, and the number 4. And if you just caught my show for the first time ever, whether it's live or you're watching later at a different time, if you want to know when I go live and you do not want to worry about YouTube making sure that they send you the notification, which I rarely get on anybody that I subscribe to, text the word LIVE, LIVE, to 844-935-3634. Why Not says thank you, and you are very welcome. And I hope you guys all have a fabulous rest of your day, fabulous rest of your week. And I will be back again right here at 1:00 p.m. Pacific time next Wednesday. We'll talk to you guys all real soon. Bye-bye.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call Mom.
Thank you for tuning into my show. I'm Debbie Marcoux, and I am the Mortgage Mom. I'm licensed by the Department of Financial Protection and Innovation under the California Business Consumer Services and Housing Agency, NMLS ID 237926. Also licensed in Arizona 0941504, Florida LO 76508, Georgia 69178, Hawaii 237926, Idaho MLO 208-023-7926, Illinois 031.005-8339, Nevada 57237, North Carolina I-210940, Oregon, Tennessee 184373, Texas, Washington MLO 23